There's a really good example. Like if we just take a look at silver and use the Fibonacci extension here, we go from the low that we had over here. We had this big run up, this peak, and then we come down. And we talked about, well, maybe, I don't know if I talked about it with you. I probably did, but we had this target around 72 to the upside for silver. And we got long gold for a quick trade with 15% right up to our target here. It had the hiccup and then it had the blow off phase before it went into a big correction.
Silver's recent price action offers a textbook example of how momentum phases often mature. Using Fibonacci extensions from the prior cycle low, the initial surge, and the corrective pullback, the upside projection clustered tightly around the $72 level. Price moved directly into that zone, confirming how stretched momentum had become and signaling a late-stage advance rather than a fresh base. Chris Vermeulen, a respected technician known for probability-driven setups, highlighted how similar structures played out across metals. Silver reached its projected extension almost precisely, while gold delivered a clean tactical move of roughly 15% into its own target before stalling. Historically, this sequence, strong impulse, brief hesitation, and a sharp blow-off, tends to precede elevated volatility and corrective phases. It doesn't negate the broader trend, but it does shift the focus from chasing upside to managing risk. Now, we present the clips from Chris Vermeulen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Things are getting really wild. We've seen margin increase twice on silver. It just means there's a lot going on, and we need to be aware we could have a big reversal at any point. Now, you're right. This type of bar, when it gaps higher and then pushes up and then gets slammed down and closes below the previous day, that is like a bearish engulfing candle. The red body completely engulfs the previous day. It went higher, it closed below it. It's usually a reversal candle. Now, a reversal candle is only good for 1, 2, or 3 more bars after it. It doesn't, specifically mean it's the top for silver. The big thing with this inside bar, as you mentioned, this big red bar, is now price is going to trade sideways in here for a little while, and we need to see which way it's going to resolve. You're right. This is a bearish bar. Price might consolidate sideways here inside this range, and it could easily break down and have a bigger pullback before it maybe wants to go higher. And there's a really good example. Like if we just take a look at silver and use the Fibonacci extension here, we go from the low that we had over here. We had this big run up, this peak, and then we come down. And we talked about, well, maybe, I don't know if I talked about it with you. I probably did, but we had this target around 72 to the upside for silver. And that is the Fibonacci measured move, just based on this move up, the big correction, and then, of course, the 618 and the 100%. And once you hit that level, that's a level we locked in 20% gain. We were long an SLV trade with one of our strategies. We closed out a trade there. And then, of course, price got into this kind of blow off phase, this emotional move. And this is what happens when you hit these Fibonacci targets and then suddenly the crowd jumps in and creates this volatility. That means the price charts are painting a very clear picture of what's going on. And we did the exact same thing with gold. If you look back at gold and we just go back to this previous chart right here, it's just amazing how these charts, play out. We had the rally up and then we had this pullback and we carried this over. And so we got long gold for a quick trade with 15% right up to our target here. It had the hiccup and then it had the blow off phase before it went into a big correction. So the market, it's kind of rotating. We're seeing it happened in gold first. Now it's happened in silver, platinum, and palladium. Gold has had a pullback, a fairly sharp pullback for gold, but overall it's still, has a stronger chart pattern. But the charts are really strong here, saying that the trends are still up, but there's a lot of volatility. And people, I think, there's other two camps. There's other people who just buy gold and they keep it forever. And, they think the world's going to fall apart and all that stuff, and they're never going to sell it. And then there's other people who want to try to navigate it and trade it. And we could see a very big correction in 2026 in the precious metals space, which I think is going to be a huge opportunity. And I don't believe in holding something if the trend turns around. So I'll be looking to exit physical metals. I can always get back in later, but I think 2026 is going to be a difficult year for metals. I do think silver could spike dramatically higher. I mean, when you look at the log scale and this giant bull flag pattern, I mean, this isn't a pattern I've ever really showed anywhere because it does point to some crazy high pricing for silver. So based on this this run up from the 2000 low and the big pullback, it's really just breaking out of the high that we saw back in 2011. This tells us kind of, that upside target. It's 57 was the upside target for it. And then we had to drop down to intraday charts, which you and I did in a previous video that pointed to around 72. Right now we're in bubble phase. So silver can pop and take off. And I do still think we could see one big push in silver. Could spike potentially past 100 very quickly. I think it could be short-lived. I think it'll be an emotional-driven move. It'll be pure FOMO. Everyone piles in to get involved, and then it'll probably reverse and come back down. But I do believe in what you said and some of your other guests saying, once it does top out and pull back, I do believe it's going to hold above 50. I think it's broken that threshold. And so now I do think it's going to naturally, it's going to become the new floor for silver. Maybe down to 40 to 50 will be the new floor, which is great. And it'll build a base. And then I think over time, when it starts to break out, then we'll be off to the races to 100 plus for silver. I guess, again, I'm really bullish on metals. It's just short term. I'm getting a little nervous, and we just have to let this bubble burst. And then we're just going to have to digest and wait for the next foundation, like the next base like this to build out. Does it take 6 months? Does it take 5 years before it starts that next big run? We don't know. But the volatility and the crowd psychology of people moving in is telling us we're on the last few bars when it comes to the monthly chart. We probably have 1 or 2 bars left, and we're going to see the metals probably top out across the board for potentially a year or so. I still think we could see gold move up to 51, 5,200, and then I think it's going to pull back. I think that's going to happen in 2026. The pullback might be short-lived. It might only be 3, 6, 9 months, and then boom, we're back off to the races and heading higher. But obviously, if it does pull up to this 51, 5,200, it will have a really steep correction, I think, a very sharp one. And it'll be a huge opportunity to either buy more or to get back in, depending on if you sell, once it starts to peak out here. But I do believe we're going to see gold try and grind higher still for another month or two. And then I think we're going to see a very sharp pullback. But I think by the end of next year, gold will already have bottomed and same with silver, and we'll be moving higher. And I think it'll be a great time to get into, I think, miners. I think that's when miners are really going to explode. They're going to build a base here over the next several months or 2026. And then I think we're going to see a very big move together. So I think by the end of next year, the precious metal space will be very exciting, similar to what we saw in 2007. It's fairly short-lived correction. And then boom, you just head off into a multi-year rally, and you'll want to own probably a lot of metals, a lot of miners, and probably uranium and whatever the new big sector, which will probably be like data centers and AI and robotics, during the next major bull cycle.
Volatility across precious metals has reached an extreme phase, with silver flashing classic late-cycle technical signals. Multiple margin hikes, bearish engulfing candles, and wide intraday reversals suggest the market is transitioning from momentum to digestion. After rallying into key Fibonacci extensions near the low $70s zone, price behavior shifted into an emotional blow-off pattern, similar to what gold experienced earlier in the cycle before correcting. These structures rarely mark the end of a bull market, but they often signal the final bars of an advance before a sharp pullback or extended consolidation. What stands out is rotation. Gold moved first, silver followed with greater force, and now platinum and palladium are echoing the same volatility. Log-scale patterns still point to higher long-term potential, yet short-term risk has clearly risen. A corrective phase in 2026 could reset sentiment, establish a more substantial base above prior resistance, and ultimately set the stage for the next multi-year advance across metals and miners. Let's get back to the interview.
When there's this type of volatility, like gold still has a very nice chart. I still think gold has got the target to reach around 51, 5,200, I hope, to the upside. But when we get this type of volatility, David, I really don't want to be holding stuff because I know it is a roller coaster ride and it could reverse. It's usually a sign of weakness. It's usually the market is running out of steam. There is a reversal coming. And the thing is, we're in this parabolic explosion phase in precious metals. And you just have to have your finger on the trigger. And I'm remaining long. But as you said, this type of volatility, I don't really like to be involved in stuff when it's like this because now the underlying trend is still up. We're just going to ride that trend until proven wrong. wrong till that trend has changed direction. But you got to be cautious because this type of price action is pretty scary. And the monthly chart of silver is such a great way to, to look at what's going on. When you zoom way back in time, you get these giant spikes that go straight up and they usually don't end very well. And I keep seeing, I mentioned, this the other day online. And of course, everybody's like, this time is different. This is, everybody says that each time. But to me, this is a very crowded trade. People have all moved into everything that says the word metals and mining into it. We're seeing just stocks and everything shoot higher. But I'm very, very weary of where this will be probably 2 or 3 bars from now, which is 2 or 3 months. January is a huge month for the equities market. If the month closes positive for the candle, we usually have a positive year for stocks. If it closes negative, it could be down. You and I, in our last talk, we talked about the cycles at play, the Benner cycle at play, that are pointing to, precious metals and the stock market and the economy weakening and pulling back. And, if we were to just look at this is a monthly chart of silver that I kind of already drawn on. This red box brings us up to about 5,200 in gold. In the perfect storm, gold will move up to 51 or 5,200 in the next month or two. It'll be a very explosive move. Who knows where silver, platinum, and palladium will go? They could go very high. But then we're going to go into a big correction, potentially a 20 to 35% correction, very similar to what happened in 2007, 2008. We saw that pullback. And then we start into another multi-year big move up where I think we see $7,500 gold and beyond. So I'm still really bullish on metals long term, but I think we're going to walk into this roller coaster ride in 2026 because when gold has these parabolic moves and breaks out of these ranges, just like it did in 2006, 2007, it's usually a warning that something bad is brewing and unfolding. And so gold is pricing in for that. That's why gold has gone from 2,000 to 2,200, 23 or 4,300 is because it's already pricing in instability, things breaking down. And I think there's some upside. I know you and I, when we talk about this, and I always reference 2007, everybody's like, well, this is nothing like 2007. And I fully agree. I think one of the best examples there's a couple of examples. You get into these bear markets. It could be the tech bubble. It could be the financial crash. Either way, price goes up or down in a very similar way. And it doesn't matter if it's because there was worthless tech companies or if it was the banking and the housing market blowing up. They're totally different, completely unrelated, yet the markets do the same thing. And I think a good example of this is when we look at the tariff chart here of what happened this year. The sell-off in February, you see this sell-off, it's sold off. That was news. That was based on tariff move, right? Well, take a look at what happened with 2025. This year we had the tariff move, but look at 2020, the COVID. It's the same thing. It doesn't matter if it is somebody putting taxes on imports or it's a pandemic and people are dying and there's all kinds of world-changing things going on. Price does the same thing. It doesn't matter when somebody hits that sell button or the buy button. The market doesn't care what the news is. It's either people are buying from greed or selling from fear, and you just have to identify this. So there's no doubt the market condition we are in right now for precious metals is different. It always is different. And there's definitely some very strong signs that something big is brewing with lots of gold going overseas to Shanghai. We're seeing institutions. We're seeing, a lot of big buying, but by big firms and things, the central banks, right? So there's definitely something brewing. But again, you can't just buy and hope. People have been waiting up for this move in silver, and a much bigger move in silver for like 20 years, 25 years since I got into this. So I like to take profits, play the charts, not the expectations or the news. I believe buying, gold and silver right now. I mean, I think you've missed a good chunk of the move. You're in for a roller coaster ride. I think if you're just a retail investor, you're not betting the farm. You're not putting, huge amounts down of your life savings. It really doesn't matter. In the long run, precious metals should move higher and go up to the upside. I think buying right now, I think you're buying kind of at nosebleed territory. It might take still several years or a year or two to get back to where it is after the dust settles, I think in 2026. But there's a million different ways to trade precious metals. I've always been one for just buying brand name bullion. I don't buy anything fancy. I don't buy coins with all kinds of stamps on it and different stuff and pay all these big premiums. I just want ounces of the cheapest metals I can get of gold and silver. So I don't think there's anything wrong with going out and buying rounds. So it doesn't matter where you buy them. I think if you're a strategic investor and it's a chunk of your wealth versus just going out to buy some for retail to be like, hey, I bought some rounds. It's a different game. I think you need to move, and as you look at these cycles, I mean, you really don't want to wait, 20 or 30 years to get back to break even, or wait another, 10 or 15 years to get back to break even. And that's where potentially people could be buying right now. They might not see big returns for 3, 4, 5, 10, 15 years for all we know. And for Christmas, I know a lot of people gave silver rounds for Christmas and that aren't in the precious metals space. So that is one of the reasons why we're in this frothy, big volatility in the market. When the retail people are piling in, that's when we keep seeing these bouts of big selling of institutions and savvy investors saying, you know what, this is a little overdone, and they're dumping contracts or dumping metals positions to lock in gains, because usually the retail are the last people in.
Volatility across precious metals has entered a dangerous but familiar phase. Gold's broader trend remains constructive, with upside momentum still pointing toward the $5,100 to $5,200 zone, yet the violent price swings signal a market that is running hot. Parabolic advances rarely resolve smoothly. History shows they often transition into sharp corrections before the next durable leg higher. This is especially true when positioning becomes crowded and price action turns emotional rather than methodical. What matters now is structure, not headlines. Monthly silver charts reveal repeated vertical spikes that end with heavy retracements, often in the 20 to 35% range, before rebuilding strength. Gold's breakout is already pricing in economic stress, capital flight, and rising instability. A corrective phase in 2026 would not invalidate the bull market. It would reset sentiment, flush weak hands, and prepare the groundwork for a much larger multi-year advance beyond current targets. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.